good with that? 5-2A? Okay. 5-2A. George Company bottles and distributes Be Light, a diet soft drink. The beverage is sold for 50 cents per 16-ounce bottle to retailers, who charge customers 75 cents per bottle. For the year 2014, management estimates the following revenue and costs. So basically we've got the sales, the direct materials, direct labor, overhead, that's variable, overhead that's fixed, the selling expenses that are variable and fixed, admin, variable and fixed. We're supposed to prepare a CVP income statement for 2014 based on management's estimates. Then we'll compute the break-even in units and dollars and compute the contribution margin. So the first step that we're going to do is compute this income statement. So we've got here, I wish I could make this bigger. Can't. What are, oh, actually, I think we've got it all sitting right here. It tells us the net sales. It tells us all of the various expenses. Our job is to compute an income statement showing the breakdown of variable and fixed expenses. So our sales here are 1,800,000. And then we've got variable expenses. The first one we have, cost of goods sold. What are the variable cost of goods sold we have here? Should we determine the variable cost of goods sold? What are the direct materials? 430. What is the direct labor? And the variable manufacturing overhead? And what is that total? 740, 8, 9, 10, 11. So 1170. So if we take the direct materials, the direct labor, and the variable manufacturing overhead, we've got the 1,170,000. Okay? And we calculate that by direct materials, 430, direct labor, 360, variable manufacturing overhead of 380 to have total cost of goods sold 1,170,000. Okay? Tell me if I'm going too fast or to slow down. Do you guys want the light on, or is it okay like this? Okay. Next, it wants us to compute the break-even point in units and then the break-even point in dollars. So if we calculated the break-even point in units, how are we going to do this? Break-even point in units, break-even point in dollars. So in units, what do we anticipate our net sales to be? What do they want our net sales to be? Yes. So does it tell us what our net sales needs to be here? Let's look here. Go back. You see our net sales is going to be 1,800,000. So it tells us that. So we're going to start by our net sales of 1,800,000, right? And then what are our variable expenses? Does it tell us it's a percent of sales? What if we add up the variable costs compute the break-even in units and in dollars? Okay, so our variable expenses are 1,260,000, and how are we figuring that out? We should be able to figure that out. Our direct materials are going to be variable, right? Our direct labor is going to be variable. Our manufacturing overhead is variable, right? Variable costs 70%. So if we take the 430 plus the 360 plus the 380, is that the 1,170,000 from the previous problem? Yeah, 1,170,000. And then if we add to that our variable selling expenses and variable administrative expenses, what do we end up with? Not 1,260,000, right? So our variable expenses are 1,260,000. 1,260,000. And so what's left here? Our contributions. $540. So our variable cost as a percentage of sales, wouldn't we take this 1,260,000, divide that by our net sales to be variable cost as a percentage of sales of 70%? And then what are our variable costs per bottle? How much do we purchase the bottle for? 75 cents. We purchase the bottle for 50 cents, isn't it? We purchase it for 50, we sell it, or we purchase it for 50 cents. So what is the variable cost per bottle? Wouldn't that be basically 50 cents times 70%? Which is our 35 cents, right? Contributions per bottle. How much is the amount we get to contribute per bottle? If the 50 cents is what we purchase it for, our variable cost are 35 cents. Aren't our contributions per bottle 15 cents then? Right? So basically, our contributions per bottle are going to be our 50 cents minus our 35 cents. So our contributions per bottle are basically 15 cents. Okay? Got it? Equal 15 cents. So, what are our total fixed costs? 405,000? Right? So we could calculate our break even in units by taking this 405,000 and dividing it by 15 cents, because that's what we get per bottle. So wouldn't we need to sell 2,700,000 units to come out with our break even in units? Do you guys see how I did that? How many kind of get it?
What did you divide the cost by?
15 cents per unit, because each bottle gives us a contribution of 15 cents. Okay? So we need to sell 2,700,000 units to break even. Now we can do it the same way, but we can do it in dollar amounts. You tell me when I can go on, okay?
What did you get contributions from the 540?
Okay. The contributions mean our net sales, or our sales of 1,800,000 subtracted from all of our variable costs, meaning here's our the amount that we have to go towards fixed costs. So basically, the contributions means everything that can be allotted after variable costs to cover our fixed costs. And so it's just the difference between the two. Then I'm just looking at what percent of the variable costs are linked to sales, 70%. So we can just break that down per bottle. If we're buying the bottles or manufacturing them for 50 cents, 70% of every bottle goes for variable cost, which means 15 cents goes for the contribution, that CVP amount that goes for fixed costs. Okay? So all we're doing here then is taking what our fixed costs are to determine how many bottles do we need to produce. Does that make sense?
Question.
Yes.
I don't understand. So if you already have your net sales, like, when are you doing this calculation? Because if you already have your net sales, wouldn't you have already produced? Or is the net sales an estimate?
It's all estimates.
Okay.
This whole thing is an estimate. So basically, if they want to show net sales of X amount, how many do they need to produce just to break even? This entire thing, these are all estimates in planning.
So you're saying if they wanted to do 1,800,000 in sales, they would have to produce 2,700,000 bottles
To break even. Just to break even.
Okay.
And remember, good question. All of this is totally estimates. George Company bottles and distributes Be Light. The beverage sold for 50 cents. For the year 2014, management estimates the following revenues and costs. They're just planning out. And in planning out, what does this mean, how many bottles they need to produce based on certain costs and certain variable expenses. Now, guys, can it all change overnight because one number changes? It can. But these are all kind of pre-planning estimates. Make sense? Okay, so we computed that break even in units. Let's look now and try to show it in dollars. So if we have 2,700,000 units And what is the amount that we're going to show per bottle? 50 cents. So this is per bottle. Then the total sales are 1,350,000, right? 1,350,000. So all we're doing is, this is what we need to purchase, manufacture in units. This is what we need to manufacture in sales dollars. Now for C, it tells us to compute the contribution margin ratio and the margin of safety ratio. So what is that margin of safety? That's between what we expect our net income to be versus the break even is our margin of safety. So our contribution margin ratio, how are we going to determine that? It's going to be 50 cents minus 35 cents, or 15 cents, divide that by the cost of 50 cents, is our contribution margin of 30%, right? So we're taking the cost of 50 cents minus all of our variable cost of 35, coming up with our contribution divided by 50 cents gives us 30%. And our margin of safety, how much ultimately do we want to make in sales of 1,800,000? And what is our 1,350,000? What do we need to do to break even? 1,350,000. See here? We want to make 1,800,000. But to break even, we need to have sales of 1,350,000. So if we take here our 1,800,000 minus our 1,350,000, that difference is going to equal 1,800,000 minus 1,350,000 is 500. 450. 450 divided by, what's that going to be? The 1,800,000 basically. Our 450,000 divided by our 1,850,000 is going to give us what? 25%. So basically, you know what? I'm screwing you up. Margin of safety here. The margin of safety is the 1,800,000 minus the 1,350,000, and divide that by, which is basically 450. Divide that by our 1,800,000. 1,800,000. That gives us our 25% formula there. Okay? Sorry, guys. I'm doing it at the wrong thing. So our margin of safety is basically what we want to make versus the difference between the break even to what we want to make. Gives us our 25% margin of safety to go over our break even. D. D now states, determine the sales dollars required to earn net income of 180,000. So if we are going to have income of 180,000, What kind of sales do we need? What are our variable costs? Or excuse me, what are our fixed costs? Our fixed costs are what we really need to take into account. Aren't they 405,000? Where did we show that? 405,000 are our fixed costs. If we take our fixed cost of 405,000 plus what do we want to make? 180. And if we divide that by 30%, which 30% is what we calculated back up here of our contribution margin ratio. If we take 30% there, what is it we need to sell? The 405,000 plus the 180, divide that by our contribution margin, 1,950,000. Okay? 1,950,000. It's not liking me. How about this? 405 plus that divided by, yeah, that's what it's got to be, 1,950,000. Sorry about this template. So basically the point here with this whole CVP is to be able to break apart your variable costs from your fixed. Your variable costs are going to be included per unit anyway, or the combination mixed or variable. The difference after sales minus your variable cost is the amount you have to get applied to fixed cost, right? So then you can determine based on this analysis, based on what your fixed costs are, plus how much you want to make in net income, you can then determine how many dollars worth of sales you're going to need to have. Okay? The key here, I just want to go over a couple problems you might see. Let's see where I am. Got too many books up here. Here we are. Let's go over a couple problems you might see. Okay? Here, let me turn editing on. I just want you to see kind of what I'm looking at, okay? The general ledger of Oates Company has the following work in process accounts. So it's kind of giving us the balance, materials, labor, overhead. It tells us the how many units were begun. Wait, that's wrong. Whoa. Question bank. I got 4. Chapter 5. Here we go. Okay, let me just show you the kind of questions you're going to see, okay? They're already in here, so let's see if we can do some of them. Ponsco Nursery used high-low data from June and July to determine its variable cost of $18 per unit. Additional information follows. So basically, we're seeing the month of June, the units produced, the total cost. In July, the units produced, the total cost. If Ponsco's produces 2,300 units in August, how much is its total cost expected to be? So what we would do here, guys, if we're using this high-low method, how would we go about determining the fixed cost? Do you remember? Do we go about determining what the fixed costs are, guys? Do you guys remember this? How do you think we're going to do it?
Doesn't it say it already did it though?
What?
Doesn't it say it used the high low from June and July to determine that it's $18? So would you just multiply the $18 by the
Okay, so good point. So if the variable cost of this is $18, would we take our 2,300 units, and we know the variable cost in that is $18, but don't we need to determine what the fixed costs are? How are we going to determine those fixed costs? Won't we try to get an example between one of these? Let's look at June. 2,000 units at $18 a unit is how much? 36? So what does that mean our fixed costs are? 12,000. Let's just do it again. If we have 1,000 units here at $18, what does that mean our variable costs are? 18,000. What does that mean our fixed costs are? 12,000. So would we, in determining this Ponsco produces 2,300 units, would we take 12,000 as our fixed, and then would we take this 2,300 units times 18? And the combination, would it be 53.4? Does that make sense? So the high-low method, you're going to take that fixed component and add to that the variable component. Okay? Does this help kind of going through some of these? Or do you care? Okay, let's look at this one, guys. Let's do an income statement by using this variable costing. So here we've got variable production costs of $95 per bike, fixed production cost of $400,000. Then we've got,
It's a chapter 6 question.
God, smack me. We'll go, I promise you, we'll go over some of these for the other, when we hit 6. Oh, how about this one, guys? A variable cost is a cost that varies per unit at every activity level? No. Varies in total in proportion to changes in the level of activity? Occurs at various times during the year? No. May or may not be incurred depending on management's discretion. Do you see what I'm trying to do is kind of give you an understanding of what kind of questions you're going to have? Okay, let's go back and how about this one? Here are delivery costs and utilities. We have to look and see what kind of costs these are. In delivery costs, September, there were $40,000 of costs with 40,000 units produced. In October, $55,000 of cost with 60,000 units produced. Do you think these are, okay, so that's one type of cost. Look at the utilities. In September, $84,000 of cost with 40,000 units produced. How much is that per unit produced? Anyone? If you take 40,000 units, divide that by $84,000 cost, what do you get? $0.40? Maybe, how about $2.40? Isn't it like $2.40 per unit? 84,000 divided by 40,000 units. I'm sorry. Take your cost and divide it by the number of units. $2 and how much? 2.1 per unit. What if you divide the $126,000 amount divided by 60,000 units? What does that give you? What does that tell you about that cost? It's a variable cost because it's the same amount per unit. Do you get what I mean? In other words, it's a certain amount per unit. You're always going to have it. Okay? So as your units increase, what happens to your cost per unit? It goes up proportionately as far as it's still $2.10 a unit. Right? So don't we know that's a variable cost there? What would be a fixed cost? A fixed cost would be 84,000 is the amount at 40,000 units produced, and 84,000 would be the amount at 60,000 units produced. That would be a fixed cost. It doesn't change even though your units increase, right? But doesn't this show you it's got to be a variable cost? Because as the amount of units increase, what happens to our cost? It's still $2.10 per unit. Okay? Remember, a fixed cost is the rent on this building. If there are 10 students in here or 40 students in here, what's the rent going to be? The same. So if I show $10,000 in rent times 10 students, or $10,000 in rent times 30 students, what does that tell us about that cost? It's fixed. Doesn't matter how many students I have in here, the cost is fixed. If the cost goes up $2.10 per unit, you know it's a variable cost. We need that cost is per unit. Make sense? Let's look at delivery cost. Do you think those costs are variable? No, look what happened. $40,000 at 40,000 units, but then what happened in October? It's 91 cents a unit, so wouldn't you think that's probably mixed? Does that make sense, guys? Are you bored? Are you hot? Is it hot in here or is it me? This weather just really is nasty, isn't it? How many of you guys woke up to like 5 below zero? Ugh. Hate it. Okay. Do you guys want another one of these before we move on? Okay. Let's see. What is a fixed cost? A fixed cost is a cost which varies in total with changes in level activity? No. Isn't a fixed cost going to stay the same no matter what the level of activity is? Does that make sense?
Doesn't a fixed cost get less?
The fixed cost is going per unit, it gets less. But overall, it's going to stay the same, isn't it? You guys get that? Who's got that attendance sheet?
It's over here.
Good. Did everyone sign it? Yes, no?
No. There's a couple random.
Get your name on that. Oh, that's right. In this class, everyone gets to sign till whenever. Is that what we agreed upon?
Yeah.
Anyone? Calling once, calling twice? Okay, guys, any questions on this? Do you want to go over a couple more, or we want to move on? Move on? Who wants to move on? Now, those of you who were in here know you can take the test until when? Quiz number 2, you can take it till Wednesday, okay? I think what I'm going to do for this quiz for 5 and 6, I'm going to give you the options of a couple problems, and you'll know that you're going to have the multiple choice you're going to have to do well on. But the problems, I'm going to give you the problems. So, no, but at least you know them, so going into it, you can have worked them out. Make sense? Okay? So I'll have this for you on Thursday. Are we doing okay? Okay, let's go to chapter 6. Well, I thought it was chapter 6. What did I do there? Why did I put 7? Chapter 6.